forgetting for a minute, of course, whether he violated SEC rules about disclosure, which, the legal authorities are going to investigate. I think he really, unfortunately, hurt his shareholders very badly, and that's what he's paying for today.
Ultimately, he made one acquisition too many, or perhaps he chose the wrong target. Perhaps had he acquired Lehman instead of Merrill, he'd be viewed as a hero today instead of a goat.
At the end of the day, it seems like Ken Lewis was passionate about wanting to leave on his own terms, or be able to say that he wasn't forced out. And so I think he did this a little prematurely so that he could say, I'm leaving, and it's my decision to do that.
He's obviously been through a difficult time over the past year, well, clearly he could pop up in another sort of chairmanship role at some point, but I think his executive positions are probably now over.
All right, folks, weighing in on the resignation of Ken Lewis. He does plan to step down from Bank of America at the end of this year. And now to another financial executive. Bloomberg has learned that Kenneth Feinberg, the Obama administration's special master on compensation, is expected as soon as today to formally approve an annual pay package worth about $10.5 million for AIG CEO Robert Benmosche. The insurer, which received a U.S. bailout valued at $182.5 billion, was criticized earlier this year after it paid $165 million in bonuses to employees of the derivatives unit, blamed for the firm's near collapse last year. Benmosche replaced Edward Liddy as head of the company in August. He will receive $3 million in cash, $4 million in common stock. Benmosche is also eligible for as much as $3.5 million a year in long-term incentive awards and is not eligible for severance if fired.
All right, hedge fund managers out there, watch out. Large financial firms are cloning your products and at a cost far less than what you currently charge. Brendan Lothry looks at the relatively successful area after tracking it for a little while of synthetic hedge funds. Brennan?
Yeah, look, they actually look like they are actually delivering on their promise to provide returns without having to pay up for them. At least that's according to a recent academic study entitled, How Do Hedge Fund Clones Manage the Real World?, which is making the rounds in the industry. Major financial institutions like Goldman Sachs, JP Morgan, Merrill Lynch have all been offering synthetic hedge funds to institutional clients for a few years now. These replication funds attempt to mimic hedge fund returns via a number of different statistical trading techniques, and according to the authors of the study, these clone funds are hitting their mark. They found that many replication funds provided low correlation to traditional market indices, tracked the broad hedge fund universe pretty closely, provided better liquidity, and charged fees far less than the industry standard 2 and 20. Now, investors, however, haven't really caught on to them yet. The market for replication funds is just a fraction of the $1.4 trillion in traditional hedge funds. But that could change. Andrew Lowe, who's an MIT professor who has written extensively on synthetic hedge funds, has already started his own retail mutual fund practicing this particular cloning technique called the ASG Global Alternatives Fund. Now, Eric Wallerstein, one of the authors of this study, says the market for replication strategies could potentially grow to about 10% of the hedge fund industry if their performance keeps up. He adds, if or when we have this 10%, this is definitely something hedge fund managers should worry about when it comes to their fees. And as the old saying goes, time will certainly tell.
That's for sure. All right, Brendan, thank you so much.